When you look at the United States, China, Russia, they're all trying to coerce some part of the world to join them. If it's the US, it is Greenland or potentially Canada, or you have China with Taiwan or Russia with Ukraine. Europe has a waiting list of people wanting and countries wanting to join it. I think that right there is a testament to the level of consent that they have created. And again, if I'm looking at a place to allocate capital, it starts to look pretty attractive.
Welcome to Smarter Markets, a weekly podcast featuring the icons and entrepreneurs of technology, commodities, and finance, ranting on the inadequacies of our systems and riffing on ideas for how to solve them. Together, we examine the questions: are we facing a crisis of information or a crisis of trust? And will building smarter markets be the antidote? This episode is brought to you in part by Abax Exchange, bringing better price discovery and risk management tools to navigate today's commodities markets through centrally cleared, physically deliverable futures contracts in energy, environmental, battery materials, and precious metals markets. Smarter markets are here.
Welcome back to Summer Playlist 2025 on Smarter Markets. I'm Dave Currie, Chief Economist at Abax Technologies. Our guest today is Jeff Currie, Chief Strategy Officer of Energy Pathways at Carlyle. We'll be discussing the implications of the breakdown of the world order that has defined the post-World War II era, implications he lays out in his new paper, The New Marshall Plan, the sequel to The New Dual Order. We'll be discussing how the quest for security is becoming the paramount force reshaping geopolitics, energy, and investment. Hello, Jeff. Welcome back to Smarter Markets.
Hey, Dave. It's great to be here.
Well, it's great to have you. We have a lot to talk about today. You've got a new paper out, and I wanted to dive into that with you. And always love having you back because you're always thinking deeply about the long-term interplay between geopolitics, energy, investment, and how about each of these sets the reality that shapes how the others will evolve. And I know in recent years, you've been thinking a lot about the role of security and how the need for it has become really the paramount force shaping events. You wrote about this first in The New Dual Order, and now you've just released a new paper titled The New Marshall Plan, where Marshall, for our listeners, is a play on words, with it being spelled Martial, as in related to war, not Marshall, as in the European Recovery Program proposed by Secretary of State George C. Marshall following the Second World War. And that's a critical distinction because you're really thinking about a fundamental change in the world order that defined the post-World War II era, which, as you have written about, that was a world in which the Western world was largely safe, capital was abundant, markets boomed, trade globalized, and supply chains stretched around the world. And this stability was predicated on a security and financial order underwritten by the United States, which now appears to be ending with the US retreating, Russia becoming more aggressive and advancing. And in a sense, the progression that we saw in the decades following the Second World War is now being reversed. And so the question is, where does that leave Europe? And that's a question you address in your paper. So let's start there, Jeff. Where does that leave Europe?
In a very existential situation. They have to change. US is retreating, Russia is advancing, and Europe is waking up. I want to start with the point that you mentioned is the importance of security as a theme, both politically as well as from a financial investment perspective. And the one thing that I really began to appreciate in doing research in energy is the importance of the ordering of security, affordability, and the environment. And one of the key conclusions we came to is whenever an investor or a politician puts the environment over security or affordability, you end up with bad outcomes. because you're not acting rationally and you're not allocating capital in the most efficient way. In contrast, if you put security above affordability in the environment, you end up with really good environmental outcomes. Case in point, France. France has the lowest carbon footprint of any country, industrialized country in the world. And it didn't get there because it wanted to save the climate. It did it through investment in nuclear power capacity in the 70s and 80s. Why did it do it? Energy security. China. China has cutting edge nuclear power technology, solar, wind, EVs, batteries, the list goes on. It made those decisions in 2000 long before it was ever concerned about the environment. It did it based upon energy security. And now I want to go back to Europe more broadly. So let's take that lesson of security over affordability over the environment. Now let's relabel them using Maslow's hierarchies of needs: fear, greed, compassion. And when we look at what Europe did over the last, call it 30 or 40 years, particularly since the fall of the Berlin Wall, is it prioritized compassion above everything else. Why? The Americans took care of the fear and they took care of the greed through low interest rates. So the Europeans entirely focused, particularly the Germans, primarily on compassion. And when we think about what this did, is it created a misallocation of capital. And when we look at what's happening right now, we're unwinding that misallocation of capital as fear goes back to the top of the list. And so we think about fear driving everything. Because let's go back to, where does this leave Europe? It leaves Europe in a very fearful situation. The US is retreating, Russia is becoming more aggressive. And so that fear now is what brought them the ability to release the debt brake in Germany. They're now doing things that needed to have been done a while ago. So it's not a real positive message from a moral perspective, but from efficiency and economic perspective, you end up with better outcomes. And one of the key messages we said in the new Marshall Plan was soldiers and weapons are how battles are won. Wars are won with supply chains and capital. And when capital is being efficiently deployed, and the key point here, and we have a picture in the paper of the boneyard outside of Tucson, Arizona, where all of these weapons rust. Ultimately, you want them rusty. You want them to have been a deterrence. And that's ultimately the real victory of the United States is that boneyard. It just sits there because it acted as a deterrent. But you and I will probably get into it. The benefits to the United States of all that investment, all that R&D, Silicon Valley, internet, GPS. I will probably talk a lot about it later on, but I think you get the point. So, bottom line, where does this leave Europe? In a situation where fear has now been elevated above, yeah, greed and compassion, and hopefully, God willing, that we don't see any hostilities ever, but that deterrence will have huge positive benefits.
Yeah, so definitely want to get to these larger issues about investment and what Europe will be doing next. I wanted to ask you first, though, sticking more to the narrower topic of energy. Now we have a situation where Europe must look to itself for its own security. It's being less underwritten by the US than in the past. And as you discussed with France and China, in the new dual order, you discussed how security is driving the energy mix and the types of energy investments being made. As Europe switches from that focus on compassion to focus on security, how do you see that impacting energy investment in Europe and the types of energy that get invested in?
Diversification of energy sources. They need to focus on a combination of renewables, natural gas. The thing about they have the renewable capacity installed. What they need are batteries and the ability to deliver that power when you need it, not when you produce it. And I think that this will give them a lot of incentive to debottleneck the system. And the other aspect is the one commodity that's oversupplied is LNG. And when we think about LNG, the question is, will the Chinese take it? The answer is probably not. They'll use their domestic sourced energy from coal, renewables, and nuclear power because they do not. The core conclusion of the New Jewel Order was places like China do not want to be tied to the vagaries of fossil fuel trade, particularly oil and gas. Europe, however, will be the biggest benefactor of that surge in LNG. So, if anything, I'm not talking about low prices in Europe, but rather that, hey, the worst is probably behind us. But I want to take a step back further to the idea of energy. And by the way, Dave, when you read the new Marshall Plan, you probably recognize it as the revenge of the old economy story, because it essentially is the same thing. Because when we think about energy investment in Europe, throw in, I like to call the acronym for it is MITE, MITE in Europe. And it's manufacturing, defense, which is the M. The I is infrastructure investment. And the T is technology like drones. And the E is energy. You need all these adjacent energy infrastructure investments to be able to accommodate that. And so it's a broader old economy tangible, good old fashioned type of asset investments that you're going to see. And energy is just a broader portion of it. So I would expect it to be energy helpful to Europe, suggesting that maybe the worst is behind us.
And moving beyond energy, this remilitarization of Europe will require tremendous investment. I believe you estimate that this could create up to 14 trillion in spending. How will this change Europe and the broader European investment landscape?
I think we're in the middle or in the beginning, the early innings of a capital rotation towards Europe. Dave, I know you and I lived through two of these capital rotations, one in '02, '03, when all the money left Silicon Valley and went to the BRICS, and then again in 14 and 15 when it left the BRICS and went back to Silicon Valley. And these were violent repricings, and the movement in currencies were substantial. And I think we're already beginning to witness that. And, when we look at the movement in the euro, flirting with 1.18 right now, and it was in parity, 6 months ago, almost at parity, which just shows you the magnitude of the shift that's already underway right now. But let's put that 14 trillion into context. First, worst case scenario, it's 4 trillion. Best case scenario, it's 14 trillion if they did everything they said they would do. Just to put that in perspective, the China boom in the 2000s, '02 to 12, was a $10 trillion boom. Put that in current dollars, it's somewhere around 15.8 or 16 trillion. So it's in the ballpark. So this is meaningful to Europe. And you ask me, what is the most meaningful thing to Europe? It's the impact that it's going to have on technology. A lot of people ask, why doesn't Europe have a Silicon Valley? Why doesn't it have a Mag 7? It doesn't have a Mag 7 and it doesn't have a Silicon Valley because it's never had a military industrial complex. And I think that's key here. And to just put it in perspective, how important the military spend is technological innovation, which two countries now spend more money on R&D than any other ones? Number one is Israel, and number two is Korea. Those two countries create some of the most innovative technology. And this is not foreign to Europe. Long before Apple, there was a company called Nokia that did mobile phones. And when we look at Nokia and Samsung, which dominated mobile phones in the beginning, what do the two have in common? What does Finland and Korea have in common? They're two most dangerous borders in the world. They needed to police them with infantry people up and down there, and they had to develop communications like mobile phones to deal with it. And as a result, Nokia and Samsung dominated this space. And why did Nokia ultimately fade and disappear? Is after the fall of the Berlin Wall and the peace dividend, Europe quit spending on R&D, particularly Finland on R&D investment. And as a result, they lost that cutting edge. So when we think about the US in the benefits, let me even point this out. Take Silicon Valley. Why is Silicon Valley called Silicon Valley? Because the US military needed a new substance that they could build chips out of that wouldn't melt in the B 70 bomber and the Minuteman missiles. And that led to the innovation of silicon. And it was, was it Fairchild Semiconductors? And these were all, military and funded investments in the beginning. So you asked me, what is the potential benefit for Europe? It's enormous here, particularly on the technology side, an area where they have been lacking for many years. So this is a huge shift.
I find it a really intriguing idea, right? Because over the past few years with the focus on net zero, I think a lot of people have developed an understanding that government spending can be a force for doing R&D, for helping new industries scale, driving down the cost basis. We saw that in renewables. And I think now you're saying we'll probably see it more widespread as this increased military spending in Europe is going to have to probably scale a number of industries there. Are there certain areas that you think in particular will benefit from this spending and kind of the driving down the cost of new technology?
My immediate answer is we don't know. I mean, you couldn't have predicted GPS and you could not have predicted the internet and AI in the 50s. So I want to first say we don't know. But the obvious answer, looking at the success that Ukraine has had in their recent campaign, is most likely be cybersecurity, drones, and things of that nature that are going to be where most of that investment is taking place. I think when we look at the standard aircraft carrier, that type of investment, it's pretty clear you don't do that anymore. But things like drones and cyber related security type investments are going to be where it. So, in other words, Europe's in a position to even be able to leapfrog the Americans to modern warfare technology. So, again, I love to be able to have the crystal ball to tell you exactly what technologies will be dominant here, but I think that's part of the excitement about it. We don't know, but the obvious areas are going to be in drones and cybersecurity.
And another really intriguing idea, I think, that comes out is you're seeing Europe's apparent weakness, its regulation, its bureaucracy could become a competitive advantage because capital likes areas with strong rule of law. And certainly, with a lot of the tariffs in the US, that's become a little bit more of a deterrent for some foreign investors, non US investors investing in the United States. What do you think Europe needs to do, though, to turn this perceived weakness into a strength?
I don't think it needs to do much. And I think that let's go back to what Europe had to do over the course of the last 75 years is it had to create consent and protect the individual, protect the smaller countries from big companies and from other states. So it created an environment that everybody had to consent to. And so when we do that joke, US is a superpower of innovation, China is a superpower of manufacturing, and Europe is a superpower of regulation. Ha ha ha. Well, that regulatory environment has a lot of benefits to it. It protects the individuals. And I think the proof in the pudding of that, let's just go over some big macro statistics. First, Europe has the best GDP or debt to GDP ratio of any industrialized area around the world. I mean, the US is at 125. You have China near 300, and you've got Germany sitting there in the 60s. That's huge. So that's benefit number one. Benefit number two is that you look at income inequality. The US is back to the highest levels since the 1930s when tariffs were at these levels. Europe has got income and wealth equality. Again, people are relatively happy. And then let's look at producer and consumer surplus. The US is dealing with crippling market concentration. Europe actually has consumer surplus. That's what they had to achieve with all that. So that starts to look like a pretty attractive place to begin to invest in. And I think as you hit the head on the nail is capital is attracted to the rule of law. And I think the rule of law is critical here. And the last point I want to make on this is when you look at the United States, China, Russia, they're all trying to coerce some part of the world to join them. If it's the US, it is Greenland or, potentially Canada, or you have China with Taiwan or Russia with Ukraine. Europe has a waiting list of people wanting and countries wanting to join it. I think that right there is a testament to the level of consent that they have created. And again, if I'm looking at a place to allocate capital, it starts to look pretty attractive.
And I wanted to ask, when you think about the 14 trillion, where does it come from? How do you see Europe financing this level of spending? If you go back to the US in the 80s, a lot of that was deficit financing. How do you see Europe handling that?
Well, let's just start with the obvious place. They got $8 trillion sitting in US equity markets and $2 trillion sitting in US government bond markets. Pull that 2 trillion out, bring it home. There's your bond market that you need to get to go pay for this. Not only you can take some out of the equity. And I think this goes to a broader point with the United States. Its fear is its own looming battle with its bond market. Because you got to ask, who is that marginal buyer of a US Treasury now? Not China. China, I think we talked about that 2 years ago, Dave, that China has backed out buying US Treasuries after the US seized the central bank assets of Russia. Japan, in the last 6 months, stopped buying. Germany is going to stop buying. So you really have to ask, who is that marginal buyer of a US Treasury now? Is it a domestic consumer? So the implications here are pretty significant for US yields potentially. But I think that, to answer your question, the resources are out there. The question is the willingness and the ability to bring reshore it back into Europe to help pay for some of these things.
Yeah, as you've mentioned, reshoring and R&D. Obviously, there's also been a lot of antagonism between the universities in the United States and the administration. I'm curious, this is a little bit outside your area, but have you seen or do you see European universities potentially trying to also attract the foreign students and the future R&D talent in this world we're moving into under this new Marshall Plan?
Yeah, the answer to that is absolutely yes. And in fact, that's what initially got me focused on this. I was at UCL, University College London, and they had a opening for a professorship, associate professor. It had 250 applications, and a large portion of them were from MIT. Now, this applies to the STEM, but we have a really good friend who's head of LSE, and he's a dean there, and he made a point to me their applications are up 3 times now. Germany is now putting money up for STEM professorships, big money. And their view is, "Hey, we got the brain drain in the '30s, time to take it back." This is serious, and I think that when you look at the tide is moving towards this side of the Atlantic. 75 years, it went one direction, and I think there's a non-trivial probability it starts to go the other direction, and if you're Germany, you're going, "Hey, that's you're probably pretty sore about all that brain drain that happened 90 years ago." Question is, how big does it become and how serious does it become? I can tell you right now, just in application numbers, is looking like it's relatively sizable.
Well, I wanted to circle back because I know the new Marshall Plan is a sequel to your report, The New Jewel Order. So I wanted to ask you, for people who are familiar with what you wrote in The New Jewel Order, how has your thinking on that evolved?
Just reinforced it, how important security is, and let me connect the 2 pieces. If we go back to 1944 in Bretton Woods, New Hampshire, when it was clear that the United States was going to be the victor of World War II, it brought all of the allied nations there and then figured out what it was gonna do about divvying up the world. And they did something that no other victor in the history of mankind had ever done before. They said, "We're not gonna occupy any of you. Instead, we're gonna give you money and develop the IMF and the World Bank." The World Bank, it was called the European Reconstruction Development Bank. And the IMF was like the monetary policy. One was fiscal policy, the other one was monetary policy. And that was to be done so that they would trade with the US. And part of the tariffs that are being knocked down, the gap was formed, and you had tariffs that were put up to protect these countries. They put all of that in place. I'm not saying they were still there when Trump did what he did earlier this year. But I think the key point here is they did something really different, is that they came in and guaranteed the safety of global trade. In exchange, you use the dollar. And by the way, here's the important realization here. Before World War II, nobody really consumed oil. Oil was not traded. It was too dangerous to trade. You wouldn't be putting ships of your most important commodity on the sea, hoping they get home safely, unless you had the US military out there backing it. So the way I like to describe the Bretton Woods arrangement is it was bombs, barrels, and bonds. Think about the bonds were the dollar that was the heart to the system. The barrels were the blood going through the veins of the system. And the bombs were the US military that was the muscle of the system. So again, bonds, barrels, and bombs were how you characterize that Bretton Woods system. And so it was very unique setup that we had really never seen before. And so when we think about what happened the world became dependent upon the oil trade. And in 1973, with the first Arab oil embargo, people go, oh, this stuff's dangerous. We don't know if we can get it. And little did the world know is by 2022, the United States would be energy independent with the shale revolution. And so when we tie it together, and let's go to the recent events this last weekend between Iran and Israel and the US using the bunker bombs with the nuclear enrichment sites. 5 years ago, 10 years ago, that was unthinkable. And so when you ask, really, what have I learned from the new Joyle order? And it's connected. So the new Marshall Plan was about the bombs. The new Jewel order is about the barrels. And our next piece is going to be about the bonds, the dollar. And all three of them were critically important. And I think this what happened in Iran is just a testament to how how different the world is that the United States 10 years ago wouldn't bombing Iran was unthinkable because what would they do if they shut the Straits of Hormuz? But Iran had no reason to shut the Straits of Hormuz because the Americans weren't scared. And I think that's a real critical observation here is we're in a different world. The Americans aren't scared of communists. They're not scared of Russia. They're not scared of running out of oil. And that's why they're pivoting and they're focusing on places like Asia right now and in China. But the energy story, what I learned from the New Jewel order is just how tied it is to what's going on in trade and what's going on with the retrenchment of the United States from a military perspective.
Yeah, and I wanted to follow up with you on that because in a world where security is paramount and we seem to have passed peak trade, right? We have a world that seems to be deglobalizing in a way. How do you see other countries and regions outside of Europe being affected by these fundamental changes in the global order?
This is the core of the bullish thesis that we laid out for commodities in October of 2020, and deglobalization sat at the center of it. Now, everybody is going to have to protect their own supply chains. I mean, that's what, we look at the world, it's getting radically more dangerous and more expensive because what were two things we could always assume that were true for the last 30, I mean, you could argue 75 years? The world was safe and money was cheap. Both of those assumptions are out the door. And the is getting more dangerous. You've got trade routes attacked like in the Red Sea. You have supply chains weaponized like China with the rare earth metals. And wars of conquest are coming closer and closer to home. Interest rates are rising, liquidity is being drained out of the system, and you have taxes going up in the form of tariffs. That makes the world more expensive and more dangerous. And the response you get for countries, not only in Europe, but to the rest of the world, they got to protect their supply chains. They got to create duplicate manufacturing. They've got to make these investments in things that they previously didn't need to consider. So it raises the cost of doing business, it raised the cost of capital. All of this, when we go back to our core original bull thesis in commodities that we laid out in 2020, it was predicated on three observations, which are actually very similar. Predicated on one, deglobalization, having to duplicate everything, just as I talked about. The second one was decarbonization. And by the way, decarbonization is deglobalization because solar, wind, and nuclear are things you can do at home. And then the third one was redistribution or income inequality. And by the way, what are tariffs put in place? What is deglobalization? Protecting your own workforce, your own manufactured labor. And so all three of these themes are pretty much tied to the same. And that's why really go back to I'm very confident in that in the structural bull thesis in commodities because of that every country has to start to address these issues. So I think it is broad spread. It's just not Europe that's being impacted.
I think there's a really interesting paradox here, right? Because it seems like outside the United States, people are becoming much more concerned with security and realizing that they don't have that umbrella that they used to have of protection. However, as you kind of mentioned with the US being willing to drop bunker buster bombs on Iran, the US almost seems to have a certain sense of invulnerability that, oh, we're fine. We'll be fine. It doesn't matter. So it seems like the US is feeling much more secure at a time when the rest of the world is feeling less. And it reminds me a little bit of back in the days of the financial crisis when it's not doing the risky thing that hurts you. It's doing the thing you think is safe that isn't safe that really gets you. If you're, sitting from your seat in London, looking back at your home country, are there things that might blindside the US that like risks it's taking that it doesn't realize?
Yeah, I think the risks are all domestic. And the images of sitting here in London, seeing what happened in Los Angeles 2 to 3 weeks ago were shocking to say the least. And I think that when we go back to those macro observations, the US has the highest income inequality it's had since the 1930s and 20s when tariffs were this high back then. The GDP ratio, the interest payments, they're going up. The US was being forced into this situation by its current situation. I like to call it, the looming battle with its bond market. And I think, these different metrics, the crippling market concentration, the lack of consumer surplus, the list goes on and on. These are all significant issues that the US is going to need to deal with. So when I ask where is the blind spot's domestically. And I would argue, people go, why now? Why is the US doing all of this now? It's because interest rates are higher. It's exposing the severity of the imbalances. We couldn't witness it before. Now we can, and we begin to realize, how significant the domestic issues are. And so if you ask me, where's the area where they could be blindsided? Well, I would argue it's, the domestic issues and confident they'll resolve it, but they need to focus on it.
I want to follow that interest rate theme with you because in a landscape changing this fundamentally, there's going to be risk, there's going to be opportunities. So I wanted to ask you more broadly, how do you see the investment landscape being reshaped? And how will investors need to think differently to successfully navigate this new reality?
I think it's focusing on new opportunities. Let's think about these other, again, you and I lived through two of these big rotations, these capital rotations, the one to BRICS and the one to the Mag 7. Mag 7, you didn't realize you were sitting on top of it until probably around 2018. I like to point out in 2011, when you can argue it really started, Exxon was the largest company in the world by a long shot, and you had this puny little company called Microsoft way down at the bottom. Nobody at the time thought Microsoft would be the dominant player that it is today, but clearly changed. But I think the key point was it was pretty clear the China story was ending at 13, 14. In fact, I remember you wrote a piece in 12 taking our views down to neutral on commodities, October 2012. It was pretty clear it was over. The shale revolution was there. We knew China and the BRICS theme were no longer the dominant themes anymore. But did we understand the significance of what was going on in the US? We had some idea. I look back and I go, what was the capital chasing then? I would argue It was shale revolution, making energy cheap. But there was also another factor that I would put in there as well about, was it Dodd-Frank? Because remember 14 and 15, when commodities were in that huge downdraft, Dodd-Frank went into effect at the exact same time. I never thought about it at the time, but I look back now and I go, the US is the only country in the world, actually, JP Morgan and the commercial banks in the US are the ones that create credit. They're the ones with the large balance sheets and the ability to originate real credit. And part of that was the regulatory advantage. Dodd-Frank, it was a regulatory headache to many involved, and I don't want to be dismissive of it. But relative to Europe and the rest of the world, it was a much more efficient capital structure. And that's part of the reason why capital markets in the US dominated. And then it funneled the capital more broadly into the Mag 7. But I think when you go back to what are these fundamental triggers that occurred, that it was, the 0203 was simple. It was China was admitted to the WTO. Boom. You unleashed that labor and arbitrage into China. And it was clear. But again, even then, Dave, we didn't know it was China until probably around 04, 05. And then you go, okay, the most recent one to unleash Europe was releasing the debt brake by the Germans. So what was it in 14? Was it Dodd-Frank? But I think the key message to answer your question is we knew it was changing. We knew the brick story was over, but we didn't understand what the news story is. And I think people go, hey, the valuations of the US tech, I mean, that's part of the reason why you look how well European equities have done. I think people look at it and go, hey, there's something here. But the question of it, can we paint it perfectly and define it at this point? Probably not. In 5 years, we'll probably know a lot more. But how to think about these transitions is I'd be positioned for it. I remember that 14 and 15 period, we'd come in every day. Oil would be down $2 to $3, sometimes $5. And in the euro would be down another 2 to 3%. And the dollar was ripping to the upside. And it went on for 7 or 8 months. Obviously, it lasted for decades, but the initial transition was pretty aggressive. So we're in for something similar to that right now.
There's a new story being written, so don't stick with the old story, I think, is the lesson I'm taking away from you. Well, I want to thank you, Jeff. You've given us a lot to think about. I think all of us should have the new Marshall Plan and the new Jewel Order on our reading list if we haven't read them already. And because this is our summer playlist series, it's been a tradition. I think we've asked you this in the past as well. But we'd like to ask each of our guests what's on their personal beach reading list this summer. Hopefully, you will get a little bit of time away with the family. So before you go, I wanted to ask you, what are you reading this summer, Jeff?
The book titled When We Cease to Understand the World. It's by Benjamin Labat. And it's about the biographies of all of the big German scientists that migrated to the US in the 30s and the 40s and their lives post the Second World War. And I think very apropos to the environment we're in right now. And so I find the stories very fascinating of what they went through. And it's kind of dark in some places because most look at the title, When We Cease to Understand the World is the title, but I think it's definitely worth picking up, and it's a relatively quick read.
Thanks again to Jeff Currie, Chief Strategy Officer of Energy Pathways at Carlyle. We hope you enjoyed the episode. We'll be back next week with another episode of Summer Playlist 2025. We hope you'll join us.
This episode is brought to you in part by Abax Exchange, bringing better price discovery and risk management tools to navigate today's commodities markets through centrally cleared, physically deliverable futures contracts in energy, environmental, battery materials, and precious metals markets. Smarter Markets are here. Contact sales at abax.exchange to get started. That concludes this week's episode of Smarter Markets by Abax. For episode transcripts and additional episode information, including research, editorial, and video content, please visit smartermarkets.media. Please help more people discover the podcast by leaving a review on Apple Podcast, Spotify, YouTube, or your favorite podcast platform. Smarter Markets is presented for informational and entertainment purposes only. The information presented on Smarter Markets should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on Smarter Markets are those of the participants and do not necessarily reflect those of the show's hosts or producer. Smarter Markets, its hosts, guests, employees, and producer, Abax Technologies, shall not be held liable for losses resulting from investment decisions based on informational viewpoints presented on Smarter Markets. Thank you for listening, and please join us again next week.